Hi, evening. I'm Yuning, the co-founder of Endowus. And if you haven't heard this already, Endowus is the first and only digital advisor that allows you to invest your CPF, SRS, and cash into globally diversified low-cost funds. We're coming to you from the Great Room in Ngee Ann City today. The Great Room is a flexible workspace with fantastic design, serves a roster of Fortune 1000 enterprises, and you can find it in 7 cities across Asia Pacific. So thank you for hosting us today, Great Room. And it's truly one of the most beautiful and best co-working spaces you can find in Singapore today. A quick housekeeping issues to highlight. Slido, the poll, if you scroll down, if you're on YouTube, there'll be a poll ongoing through the session. We'll share the results at the end. You can share your questions, Q&A, and we'll try to pull some of those out at the end to ask the panelists. If there's a specific panelist you want to ask questions to, please highlight that as well. If you have any questions at all about Endowus or other things you hear today, our client experience team will be on the YouTube channel chat and on the Slido Q&A session. So please feel free to ask any questions you have. Please do check out endowus.com. If you have any further questions or want to know a bit more about us, feel free to reach out, arrange a time with our licensed representatives to learn more about our services. And if you like what you're hearing today, and maybe you missed some of the earlier panels, everything is being recorded and you can watch after at your own leisure. And please, we would love if you subscribed for updates on YouTube, on Facebook, or whatever social media channel of your choice. Lastly, I just wanted to highlight that we're super excited that we'll be launching Endowus ESG and sustainable investing today. And over the next couple of months, we'll have some super exciting products coming out. So please stay tuned for that. So without further ado, I'm going to introduce very quickly the 4 gentlemen I'm very fortunate to be able to share the room with today. On my far left is Loo, founder of 1M65, actually now 4M65, which hopefully you can talk about a little bit. Entrepreneur, formerly held a variety of senior positions within Singtel. Joe, sitting next to him, Joe Cherian. He's the director of CAMRI, Center of Asset Management Research and Investments at NUS, and a member of the CPF Advisory Panel. Heng, the deputy CEO of CPF Board, and Boon, Chye, right next to me, the CEO of SGX. So very happy to have all of you here this evening. Thank you so much again. And I think the topic of this panel is paths to a secure retirement. I think that's something that most of us have in the back of our heads. We worry about, but some people don't do much. Some people do a lot. Lou, I think you've been on the forefront of that movement to help people think about that. But I think most importantly, maybe we should frame the discussion first. I would love to hear. Maybe we can start there and move over since you're the furthest from me. Can we define a secure retirement generally in the simplest terms possible to help people quantify that question a little bit, and also specifically maybe what it means for you? Yeah, Lou, would you like to start with that, please? Yeah.
Well, you're talking about secure retirement.
Yes.
Right?
What is a secure retirement to
okay.
you? Right. Yeah.
Well, I'm not the traditional kind of person that thinks of retirement in a form of money aspect. I think for me, retirement means that it's very important for me to be able to be financially free to pursue my passion. Right? So the concept of retirement has not so much a hard fixed date like 65, 60 or 67 years old, but more the date where I can work because I love to, not because I have to. Right? So that for me is a retirement. And if you, frankly speaking, work because you love to, then you probably will never have a date where you actually ends until the day you really, body cannot take it anymore kind of thing, right? So that's my concept of a retirement. By that measure, I think it's something that most Singaporeans should think about.
Joe?
Okay, so let's put it on the average person's goals, it should be basically getting a secure, reliable, safe, steady stream of retirement income in retirement. For me personally, it's more about maintaining my standard of living at the point of retirement, because I don't want to see a drop in my standard of living. So how do I take that journey to assure myself that standard of living with that safe, reliable income to maintain that?
So for some of the folks that are listening and trying to think about what that means in terms of a secure retirement, what are the key things to think about when you think about what you should be budgeting for maybe?
So basically the way I look at it is an individual investor can also take an institutional perspective. So what I'm trying to do is, if you know how institutions manage money, like a pension fund and so on, they do what's called liability-driven investing. That means I have a set of liabilities, expenses, consumption, vacation, leisure, that I would like to continue doing beyond retirement. So the question becomes, how do I achieve that during the accumulation period or the working period? So, I think we'll talk about the different ways to get there. But I always believe in leaving it to the professionals to figure it out for me, than me trying to figure that all out myself. Yeah.
Chin Heng, I'd love to hear your.
Okay, for me, financial security is about having a high assurance that I don't have to worry about the finances. My finances is in a good state for the rest of my life, so that I can I have the freedom to pursue other priorities that are important to me in life lah. So I see financial security as a means to an end rather than an end in itself.
Understood. And Boon Chye?
Sure.
Anything to add there? Yeah.
For me, I think retirement isn't just purely about financial security. It's not about achieving a certain number, because you can feel rich and yet you may feel that a lot is lacking, or you can feel poor, but you may actually feel that there are a lot of abundance. For me personally, it's not just having, let's say, a fixed annuity that you're free of financial burden. I think that's very important. But as Loo said, it's also important to think about continuing to be very active. And I would personally, what it means for me would be two things. You can have financial stability, but you may not have a good health. So I think retirement also means being healthy. And then two, while we may be financially sufficient, it is always important to plan for the unexpected. If you have an unexpected illness, I'm sure your monthly or annual annuity may not be able to cover that. So how to think about having insurance to help you tie over the unexpected events.
Yeah, that's a very good point, especially given the cost of healthcare sometimes, if you are unfortunate in terms of what can happen to you. But it's also interesting to go back to, I guess 1M65 or 4M65. I guess more and more people these days we hear are looking at, does that number have to be 65? But the way you framed it, are you really working? Once you have that financial freedom and financial flexibility to pursue what you want, that really opens up a lot of things. But I guess so, paths to a secure retirement, we really have to think about how do you prepare for retirement. I guess the first question here I have to ask is Chin Heng, obviously, because I guess CPF is such an important part of our retirement planning in Singapore. So maybe you can tell us a bit more about, what role CPF plays in retirement planning in Singapore.
Okay, CPF is a very important part of Singaporeans' financial planning. So I think it's known to many people. CPF is designed for the needs of the majority of Singaporeans to provide in three very important areas of their needs. To have a roof over the head for their medical needs, especially in the area of hospitalization and long-term care needs, and also for post-working, having income for life. So if you're prudent with your housing decisions and you are able to accumulate and work out your plans, having some adequate insurance, then CPF can generally provide for Singaporeans' needs. But at this point, I want to bring out this point about additional savings over and above what the system sort of provided, which I think is going to be very important going forward. We all know that the world is becoming very unpredictable. We're a volatile world. We're experiencing such an episode with COVID, and going forward, the people have to go through many career changes, many episodes of unemployment, or sometimes multiple employment, sometimes switching between employment and self-employment kind of thing. So then I think increasingly the individuals, Singaporeans, will have to take responsibility and take charge of their financial planning, and then there will be periods where they have some additional monies, and then they should be thinking about how to save these monies for the future. Right. And I just want to highlight that even within the CPF system, there are avenues for additional savings. The CPF board has been quite actively promoting retirement top-ups to supplement what the contributions you get from work, and that has generated a lot of interest from Singaporeans, which is very good. We see very strong interest in that. I want to perhaps at this point just highlight one more avenue, which is perhaps a bit less well known, which is housing refunds. So Singaporeans know that if they sell their property, they have to return back to the CPF whatever they've taken out for their property. But I think lesser people know that even without selling the property, they can return the money back to CPF. And we are seeing actually very strong interest in this area. So just for last year, we saw about CPF members returning actually more than $1 billion of the money they've used for housing back to the CPF accounts. And you think about it, for a lot of people, maybe closer to 50-50 or in the 40s, and if they have already meet their retirement sum needs, it's a very attractive proposition. It can be seen like something like a fixed deposit or a Singapore government bond, but with returns of at least 2.5%. So I think this has captured the imaginations of a lot of Singaporeans.
Yeah. So actually, that's a very interesting point, the housing refund, and I think not many people know about that. And you addressed that, by telling us about the 2.5%. But interestingly enough, one of the Slido questions, or the top upvoted questions right now we have, is given the stability of CPF returns, explain why anyone should use the CPFIS investment scheme and invest their money elsewhere. So, Lou or Joe, would you like to, either of you like to take this?
I'll take this first.
Go ahead, yeah.
So first of all, when we look at CPF, we cannot look at it as one account. There are 3 or 4 accounts that we're looking at. I'm a huge fan of putting money in the special account and not touching it. And I think it's nearly impossible for anybody to beat 4% risk-free. So it's 4 to 5% and maybe even 6% once you're above 55. So I think that part is rather difficult to beat, and you're right. So from that aspect, there is, we should not touch that at all, and we should try to top it up as quick as possible. So beyond that, your ordinary account yields 2.5%. Against fixed deposit, I think 2.5% is phenomenal. And that's also probably why Heng mentioned that there's a huge lot of people now putting money back through house refunds, because the gap between fixed D or interest rate right now. But 2.5% is somewhat beatable if you look at investments and other opportunities, whether it's index funds or CPFIS that allows. So I think that's an area that, if you have maxed up your ordinary account, maxed out a special account and your MediSave account, I'm a strong advocate that we should try to harness better returns for this. And I've been very vocal about it. And in fact, it's a cornerstone of my 4M65 strategy.
Right. And that's how you went from 1M65 to 4M65.
Yes, that's a quantum leap, yes.
Interesting. Yeah. And I'd also highlight, it's a very interesting point, because if you think about housing these days, a mortgage loan is probably 1.5% in Singapore, or maybe even lower if you're lucky. 1.3 versus, what CPF pays you as a base of 2.5, and then potentially what you could get in the markets. The recent craziness aside. I guess something else that Heng touched on, which was that the need to save outside of CPF. CPF is, we put aside a lot of money with CPF. I think up to 37% of our income. So, Boon Chye, given what you do, love to hear your views on, do we need to save up outside of CPF? And if so, how do we think about what we do with that money, and what role does SJ play in that, I guess?
Well, the short answer is yes. I think one should think about saving outside of the CPF. I heard what Lou said, which I agree with. Yes, the CPF does provide a very strong pillar, but I think there are 2 other factors to consider. One, obviously, what kind of lifestyle one would like to continue to enjoy upon retirement, so that 2.5 or 4% may or may not be sufficient. And then I think secondly, it also depends on your age group. At what point in time do you start to invest and save? If you start off young at 20 plus, time is in your favor. time value of money, or if you try and mine equity risk premium, maybe over a longer term, you could generate a higher return than what CPF provides you. But obviously, you are at 50, 60 years old, you probably can't take as much of the risk, or time value of money not quite in your favor. So I'm an advocate that CPF is a good and strong pillar, but if you can and can afford that, probably invest outside of the CPF. At the exchange at SGX, there are many investment options that investors can look at, from low-cost ETFs to yield products, very well known for REITs, but there are also other exciting sectors. But you must be prepared that you could lose some portion of your investment, so you must be prepared to be willing that, look, what you invest could generate a return, also could give you a loss. Do your homework. And for clients of Endowus, I think most of you understand index investing. There are also many different kind of indexes on the SGX that investors can look towards too.
Thank you. And I would say that probably as well, one other very important thing to keep in mind is liquidity. I guess CPF is a great solution, and the government can offer such high rates because it's long duration money. You know, you put it in, you start contributing when you're early 20s or maybe slightly earlier than that, but you can only start to draw down after a certain age. And but you also may have needs in the interim. Hopefully, you know, no emergencies or anything like that, but you know, other things that you need to save up for. So that liquidity outside that system might be interesting as well, as my personal view, I guess. So Joe, you've had a lot of experience building retirement solutions for banks, Credit Suisse, if I'm not wrong. You spent many years there in very senior positions. You also were an integral part of the MOM CPF advisory panel. You know, I guess a very broad question for you to take it however you want. You know, what are your thoughts about improving outcomes for retirement?
Okay, whether it was industry or, you know, post-industry or the panel that I served on, we used to serve on, the panel doesn't exist anymore because our job was done. I view it as sort of a similar design problem. So in industry, what we did when I was running quite a big fund out in New York, we were servicing pension funds, institutional clients, and high net worth investors, and a whole range of people. We always constructed portfolios for them that met their goals and objectives, their risk aversion, you know, downside risk controls, and so on. So at the end of the day, what we recommended doing, partly because of the kinds of strategies we ran, was to keep it low cost as possible. It doesn't mean going cheap. You got to pay for the services. It just means that try to get the best and most cost efficient solution to what you're trying to achieve. That's what we mean by that. Diversified, keep it well diversified. Being an academic, we tend to believe in being more diversified. It keeps you out of trouble. And you know, don't try to play the market too much. Leave that to the professionals. So on the CPF advisory panel, we try to institutionalize some of those things. It's not, I mean, easy to do. We try to make it lower cost. We try to make it more education there, more options, and all that stuff. But the fact of the matter is that it's not easy to get a comprehensive solution that meets everyone's needs. And that's why you have the IS. So those who want to take choices outside of the traditional system, which is a fantastic system, it's a fantastic baseline system, they can actually go to IS and get that. But my problem with that still is that there's just too much choice. When you have too much choice, it leads to investor paralysis. So what we tried to propose as well on the panel was to come up with some kind of pooling mechanism that allows for investors who don't have the time, who don't have the training, who may not have the resources, but yet want that institutional level type of investing that we used to do for our clients back in New York and here in Singapore, to be able to invest in a seamless, easy way. We call that the long run, lifetime investment retirement investment LRIS or LIRS, I forget the exact, it's been quite a few years. But it requires some amount of pooling. But the good news from that point is that a lot of technology has come into play. And I think something of what you guys are doing is similar, because I'm hearing the panels and you guys are trying to achieve that as well. But the key part is pulling it to get the cost down, so that I can, as a retail investor, as you know, someone subscribing to 1M65 philosophy, can get the same amount of access and cost-efficient solutions as an institutional investor can. And that was what the LRS was trying to do. But the good news is, even though we've not implemented, I believe we have not implemented LRS, the technology providers, including you guys, have been able to come up with solutions that address that. So we're getting there. We're not there yet, but we're getting there. And I think that's one of the biggest joy from serving on the panel that I've seen happen, that how technology has not just disrupted, but actually provided solutions that would take others longer to achieve.
One thing that really resonated with me is too much choice. If you would like, we'd be happy to volunteer to be the only choice. But that's for you to propose to MOM Lab.
I'm not the decision maker. Unfortunately, I'm not the decision maker.
So maybe a few things that you touched on that I'll ask you a little bit. You mentioned sort of risk adversity and risk aversity quotient a little bit when you think about investing. Why is that important? Risk adverse.
Risk aversion?
Risk quotient, yes.
The reason is, we talk about stocks in the long run. Let me give you an example, because I lived through it. I mean, I was still in New York at that time. I just transitioned from academics to industry. So I moved from Boston to New York, in academics in Boston and then in industry in New York. This was in the 90s. Remember the dot-com era? It was just going gangbusters in terms of returns and all that stuff. And because there's no age limit to academics in America for the term in terms of tenure, many of them say, oh, I can work. They're in their 60s, but they say, oh, I can work another 15, 20 more years. So they were still invested for the long haul. And I can tell you, some of my friends who are academics lost 50 to 60% at the age of 65.
Wow.
50 to 60% because they invest in very active, risky portfolios, mutual fund portfolios, which are very high fees too, even in America, and lost a lot of it. So what happened? They had to actually reevaluate their whole life cycle, career choice, and stuff like that. So they never realized they were risk averse until that big jump happened. It can happen. So I do think everyone has to do the test and find out, can I tolerate that amount of drawdown? That's very important before you plunge into more risky assets. That's why I say the baseline, secure, social security safety net is always the CPF, because the government will be there to provide you that returns and to keep it safe. But then beyond that, if you want to risk it, go for it. But if you don't have the training or the, I don't want to be condescending, but rather the let's put it as education to do that kind of stuff. Leave it to the professionals, the ones you trust, the advisors you trust to do it for you. That's how I put it.
So Heng, coming back to you for a second, Joe mentioned low cost, right? So you're a trained FA, trained financial advisor, are you?
Right.
That's right.
Non-practicing.
So, I mean, we talk about this a lot, but I think it'd be great to hear it from you. Why is the low cost such an important, and the diversification, I guess, such an important part of investing for the long term?
Oh, it's quite simple, because it's into the returns. So it's not just about the gross return that the whatever fund or product that you can get, but you got to net off the cost, and over a long haul, then it do add up very, very significantly. So within the board for the CPF investment scheme, in a sense, it is an explicit consideration that we look for when product providers want to open their funds for CPF money to be used. We look very carefully to make sure that the costs are reasonable and that they will serve the members well. And on the issue of diversification or risk aversion, I think my view is it's not just about whether the individual can stomach the drop in returns and so on, but inherently investing, while the expected return is attractive, it always comes with a expected risk. So the risk part is a very important thing, and investing is a very emotional issue. So you always have to deal with greed and fear, and you live with it every day when the markets goes up and down. So that is a very important consideration for somebody to consider whether you should be putting your monies to the market and risking it. And then that's where it ties in very well with what you said, that CPF comes in to provide the safety net that is not subject to market risk. And with that safety net, my belief is that people will be more prepared, better better able to take the investment risk because they know that
Right.
there's this safety net
Right.
should anything adverse happen.
Yeah, that's a very interesting concept, which I think.
If
Please,
I may,
yeah.
I mean, two great points that was touched upon, diversification and costs. I think the flip side of financial market returns is actually costs. In a very low interest rate environment which we are in now, and that could stay for a while, cost avoidance, cost can lead to cost efficiency. Whatever cost you save is actually thrown down into your net return. So I think that's a very important consideration. And yes, I'm an advocate of diversification. So one of the things that we do on the exchange is really to give multi-asset approach for investors, not just equity. You want to mine the equity premium, but there's also a fixed income component. No doubt it's harder these days to find those returns in a lower environment.
Absolutely. Actually, I was just about to come to you, Boon Chye. I mean, and this is going back to the sort of the risk adversity thing, and we think about that a lot because exactly as Heng mentioned, the ability to hold through good and bad markets is very important. What you don't want is someone to come in, invest, and then the first, like what happened last 2 days where the market drops 2 or 3% and they sell. And then, 3 months later when the market's up another 20, then start buying again. That's what you want to avoid. And I saw an interesting study a long time ago that, when some brokerage, I think it's Schwab or something like that, did some research, they found the highest performing accounts were generally those that people had lost their passwords to. I don't know if you have any good anecdotes like that, from your time at SPX, but, that was, any good anecdotes like that? In terms of risk adversity and bull and bear and things like that?
Well, there's always a cost to churning your account, and if the costs are high, that clearly is the return versus, let's say, it's a buy and hold. But a buy and hold also may make you into a complacency and not being attuned to developments that frankly could actually impact a company that you held for a long time. So I think it's a balance. Do your homework and be getting advice or make yourself capable of doing that.
Right. We're definitely in an age of change. So, so this how to prepare for retirement question. I mean, Loo, I think you're again 1M65, Mr. CPF, 4M65. You have so many names. What are some of the best CPF hacks for members? And maybe you can tell us a little bit more about the 1M65 or 4M65 movement.
Well, when we started the movement in 2015, being called Mr. CPF was a bad name. Okay, those days people were in Hong Lim protesting, return my CPF. I was being called Mr. CPF in a negative connotation. So we have journeyed on to convince people, at least a sizable chunk of people that that CPF can be a very good financial safety net and even a get-rich tool. Okay, which CPF cannot say, but I can say. Okay, so maybe just a quick introduction on 165 movement is that we are a non-profit movement that encourages fellow Singaporeans to harness the CPF, to grow it into a $1 million or multi-million dollar account by the time you retire. Okay, it's just by simply harness the mechanism of the CPF, and we have got tens of thousands of Singaporeans following our movement right now. We have grown from strength to strength. It used to be me alone saying it, but nowadays there are a lot of people who start flashing out, showing off their CPF statements, $1 million CPF statements. I think the latest was I saw a $3 million statement.
Wow.
Husband and wife together, and so I think that we have gone from early days where people don't believe to now people are now racing towards it. So CPF really is a financial safety net, of which above that, we're encouraging people to harness CPF and also beyond their CPF to take advantage of the equities market to yield higher returns. But the cornerstone and sequentially is first to establish, like what Heng said, a financial safety net, right? Racing to a $1 million, multi-million dollar savings, and then get additional extraordinary returns from your equities. So that's in a nutshell what we're encouraging.
I think psychologically it's so much easier to take a bit more risk with your investments when you know that you have a big rock behind you, that no matter what happens, rain or shine, you'll be okay, which is the beauty of that CPF system. So any hacks for members that are listening in, Heng or Loo?
Well, a couple, right? I've written quite a lot on it. The first is, once you have, like what Heng has said, once you have a financial safety net, it's a lot easier to take advantage of market crashes. So I'm a very contrarian kind of investor, and I've taken advantage of the 2000 financial crisis, the 2012, 2015, and now 2020, right? Every crisis I was able to just go in deep and heavy during the crash, simply because I know that even if I lose everything, right, I've got this CPF, multi-million-dollar CPF account waiting for me, so I can afford to lose everything. By sheer emotional stability provided by this safety net, that's the biggest hack, okay? There are other interesting hacks that we can talk about. I'll mention maybe one or two. Number one is that very few people know that you can make your baby a millionaire quite easily when they grow up by simply putting in money while they are young, and let the power of compounding, through the power of compounding, if you put money in your special account, we did some calculation. I think you need to put something like, roughly about $70,000 or so at birth, and the power of compounding will take over and hit $1 million. That's assuming that the kid does not work, does not contribute CPF for the rest of her life or his life. And of course, if they continue to work and so on, that would become a very big number. I haven't done the exercise yet, but I suspect that if someone were to harness the power of compounding and top up $37,700, which is what is allowed by CPF, from the day you're born all the way to 65 years old, I think the magic number may come out to be 8, 9 million or even $10 million. I haven't done the calculation. I suspect you'll be in that ballpark. So that's a theoretical limit that someone can hit, okay? So we are pushing the lower boundary of it to 1 to 4 million. And I think we should encourage parents to start encouraging, parents should start topping up the kids' CPF account, since every Singaporean at birth has a CPF account.
Wow.
Okay.
I guess we have to say thank you to Heng and thank you CPF for that.
CPF.
So from the CPF man himself, are there any tips or any hacks that you can give us for us we think about CPF?
I will leave the CPF hacks to Mr. CPF. But if I may allow me, I'll just share a thought that come out in my mind just now as Loo was reminding us of what happened in 2015 in the Hong Lim Park, and people were flashing those placards that says return my CPF. And just now I mentioned about the housing refund and how people are returning the money that they use of property to CPF. It just occurred to me how ironic it was. When they talk about return my CPF, they're talking about taking money from their CPF into cash in the pocket. But now when we talk about return CPF, it's using the cash and put back into the CPF.
Maybe I stress a little bit more, and I don't want to occupy too much of a limelight on this. Like for example, this year, early this year in the social media, we now see a lot of Singaporeans, I use the word, if I use the Hao Lian, showing off their CPF statements. Wow, how much interest I make, $10,000, $20,000, that kind of thing. The whole social media is very active in the area. I think on 1st of January, a lot of people cannot get through the CPF system. Everybody checking their interest, and that kind of thing. Long queues were outside CPF in the first week in their offices and things like that. That simply is a result of, years of promoting not just our CPF 1965 movement, but also CPF educating the public that what a powerful money generator that is. And I think we have reversed that notion that CPF is, those days where a lot of Singaporeans say, CPF Jalui one, which means CPF were taking advantage of their money. But now I think people are reversing that thought. So I think there's lots of things we could do with our CPF. I'll just introduce one quick last hack, which is I call it the 5455 maneuver, which is at 54 years old. We encourage everybody to quickly, 54 years old, we encourage everybody to, potentially pull out, their special account into a bond fund. And once you cross 55 years old,
Put it back.
and then put it back, So bottom line is that by doing that, the OA will be sucked up to to fill the retirement account. So you got.
You got to fix that loophole.
I don't think it's a
It's not
loophole.
illegal.
Yeah, I don't think
Maybe you
it's a
shouldn't
loophole.
share too many hacks. We'll do it in a different session.
I don't think it's loophole. I think it's if anything, we're going to help the fellow Singaporeans to get more returns. We should encourage it.
No, my point is that there shouldn't be a need for you to pull it out and put it back in. It should just be a smooth, high return type situation.
Technology to just a click and
Yeah.
transfer.
But can I bring up a point?
Please.
While we talk about these high achieving
Yes.
individuals who've done well
Yes.
in their CPF, we also mustn't forget those who have not attained that. There's a large number of Singaporeans who do not have even enough for that. There are ways around that as well. I mean, apart from saying, well, work longer, save more, which they may not be able to do in these kinds of times, there's also the equitization program. You can actually monetize your home. If you own a home, apart from paying off the mortgage, the equity eventually can be used in retirement to convert to a set of cash flows. So, to address those who have not gotten up there, there are ways in which they can get around, but they must be willing to make some sacrifices. Like, for example, I'm not going to bequeath the home, rather I'm going to use it as income for my retirement because I don't have enough. It's a fact of life, right? It's a rational thing to do. So, I just want to add that lower spectrum of people as well, who we have to worry about.
Thanks for bringing that up. I think it's a very important point. And just want to mention that the government recently announced a new scheme called the Match Retirement Savings Scheme, which is very useful. It's targeted at the people who have not accumulated a lot, and now if they top up for their retirement, there's a matching grant from the government. So those who are eligible for this scheme have been notified, but those listening here, if your parents are in this category, I think it's useful if you try to help them understand and take advantage of this scheme.
You mentioned about one of the better returns is people forgetting their password, but also on the CPF interest rate. So regardless of what one has in terms of the amount you have in CPF, whether barely enough or a lot of money, I think the power of compounding, which has been said before, is actually very powerful. So whether you have that compounded in your CPF because you don't withdraw that, or when you're investing, let's say in a fund, which I know Endowus has quite many, or even some of the ETFs, the power of compounding, I think, is something not to be neglected.
Absolutely. Eighth wonder of the world or something like that, right? So, Chin Heng, coming back to you for a second, I mean, is there a quick way to think about or quantify or measure, for people that are listening in, how well prepared they may be for retirement if they want to apply sort of what we're talking about here to their personal situations?
I suppose one of the more popular rule of thumb propagated is this 4% rule, that if you live off 4% of your asset in a year, you should be okay for average retiree, 65 and so on, and that's in real terms. So that could be one measure they use, but I will emphasize that it's just a rule of thumb.
Right.
And it's very important that one builds in margins and buffers in it, because the future is so uncertain. I just came across someone that shared that, he do his calculation, how much he need, and he basically double it, and then then you use that figure. Whether it's doubling it or 50% or whatever, but one has to be thinking about such issues lah. But then again, these are very general, and retirement is a very individual thing. So it's important to look at your own individual circumstances. And here, if I may, I just want to mention that the CPF Board recently introduces this CPF planner, specifically for this purpose, to help individuals to figure out how they are doing. And because the CPF covers housing, retirement, and healthcare, it's aimed at addressing all these three issues. So we aim to make it as simple as possible. So basically, just answer 5 simple questions, and it gives you some pointers in kind of areas that you should be looking at. So encourage everybody to try this CPF planner.
Right. And I'll try to elaborate, and please correct me if I'm wrong. But I think the 4% rule you mentioned is, let's say someone has $100 at retirement, right? That retirement income that they can be relatively comfortable using is, let's say, $4 out of the $100, if they started with $100 at retirement. And then the important other side to that, if I'm not wrong, would be thinking about what your expenses would be. Everything from insurance to if you have to pay for rental or housing, food, if you want some travel, you want some nice things, maybe school for your children and all that. So you kind of balance that and make sure that that's kind of, balances and maybe build in some buffer. Is that sort of what you were going for?
That's right.
Great, great. Thank you. I think that was quite helpful and is a great framework for a lot of people to think about what they may need in retirement. We talked a bit about investing and obviously, it's always a fun topic. I'm curious, can the average person beat the market? Joe, you mentioned you managed money as an investor professionally, and now you teach finance and investing and all that fun stuff at Camry. So can an average person beat the market?
If you belong to a social media platform like Wall Street Beat, is that what it's called?
Wall Street, sorry, what was it again?
Wall
Street Bets.
Wall Street Bets,
yes.
Yeah. Maybe you can, but I don't recommend that for everyone. It's, very difficult to pick stocks, to pick credits and stuff like that. It takes a lot of training and all that stuff. So while you need to be educated about investing, about saving for future and all that stuff, about knowing how to pick managers, not pick stocks, how to pick the right manager, the right advisor, I do recommend that unless you're a professional, don't try to beat the market. Stick to picking a good advisor or good manager. That's to the average person. But if you think you've got the right training and you've got the extra money to punt or hack or whatever you want to call it, go for it. But just make sure you have enough baseline to make sure that there's a safety net.
Right.
That's okay. But I always fall back and say, leave it to the professionals. Find a good advisor or a money manager to manage it for you so that you can enjoy doing the other stuff, like, throwing omakase parties at your home, fishing and all that stuff, Enjoy life.
Right. So that's why you've put all your money with Endowus. So Loo, MBA from Stanford, what did they teach you there?
Every day I would get messages and questions from my followers in 165 Telegram and WhatsApp. They'll be asking the question of, how do I better perform? Many of them come to me with sad stories, how they've lost money, how they listened to rumors, how they attended courses and still lost money and things like that. I came to the conclusion that that it's not just a matter of the brain, it's also a matter of the heart as well. So in order to beat the market, not only you have to have the skills and experience that very few people have, but you also need the right emotional makeup as well. I think I came to a conclusion that the best fund managers are those that are almost emotionless. When it goes up, they don't get happy. When it goes down, they don't feel sad, and they just cruise along the way. I think most average investor are not this makeup, and neither are they well trained with those exposures. It saddens me and frightens me that right now young army boys, university kids are dumping big amounts by simple technical analysis and things like that, doing some desktop research on value investing, not knowing that in a bull market like this, especially in the US market, everybody is an expert. They haven't experienced the crashes of 1997, 2001, 2008, 2015, and so on. So when those days come, then you will know that it's really difficult. So that's a long answer to your question, and I think the average person will find it very difficult to beat the market. I'm a big fan of index investing. The problem is that not everybody will feel that they are not the average investor. Okay, so I think that's where we have a bit of an issue.
Right. Maybe to tap on your experience a bit, Boon Chye, yours as a banker at SGX. I mean, what are some of the most common investing mistakes? I think we've touched on a few, but if you could recap for us, I mean, in your view, what are the most common ones you see for people to avoid?
Yeah, if I may, before I get there, I hear what Loo and Jin are saying. I wouldn't quite look at trying to beat the market. I think it's hard, I agree with that. But maybe one should define what is your expected return that you need. And also, markets go through cycle. I do think it is probably, if you are doing your homework, so it's probably not for the people that don't do their homework, it's possible to beat the market. The question is, can you consistently beat the market? Which is where I think the emotion, the ego comes in. So to answer your questions, I think some of the common pitfalls are when the emotion or sentiment takes over, and when you don't do your homework. And also some of the common mistakes are you never take your profits. You let your losses run. So, and while you can try and take away the emotions with, let's say, machines, quantitative strategies, for a while they perform well. In the last few months, in 2020, they haven't done as well. So again, it's the point of, can you consistently beat the market?
Yeah, that's a very interesting point, and on that I actually diverge a little bit from some of my colleagues at Endowus. I think I've had the good fortune of working for some people that I think do have that preternatural gift. The unfortunate thing is that most people don't realize that in order to do that, you literally have to dedicate your entire life to that and have very substantial resources at your fingertips. A fun story is, having the money to put private investigators outside factories to count trucks going in and out, or buying satellite data or credit card data. The markets are so competitive today that, to me, I think it's a very small subset of people. And again, to your point, most of us just don't have the emotional tolerance for it. And frankly, I'd rather be playing with my 2 kids. But going back to the question about mistakes that people make, do you have anything to share or wisdom to share there on what people should avoid?
I wouldn't say wisdom to share, but I think the common ones are when you go with hearsay, you go with trend, when in fact you're probably one of the last one to jump on. Always do your homework, and if not, seek professional advice, and also be mindful of stories of the day, flavor of the month, and those are typically where we get blindsided.
Heng, anything to share on this?
Oh, tons. Don't think I have time for that. I'll just share one, which is a very common mistake. Listening to stock recommendation. The first time I tried to dabble in the stocks, listen to my friends in a recommendation, and got burned. And I learned, yes, trust the fund managers, trust a good advisor. I cannot do it.
Yeah. It's interesting because sometimes when people share advice, even when it's right, you don't know when to buy and when to sell. And you're left holding the bag sometimes when things go the wrong way.
But one other way, not to beat the market, low cost strategy, which I'm sure Endowus has, is on ETFs that are index tracker, right? They don't consistently perform to beat the market, but they probably track the market if the cost structure is set up correctly.
Right. It's quite interesting as well, sort of overlaid with what you mentioned earlier, which is, when you think about investing in sort of these larger indexes and things like that, or smart beta, a lot of times that new technology, a lot of these indexes sort of auto-correct for that. Companies that are doing well get included in indexes and otherwise. And so, by taking that broad diversification, you're actually benefiting from some of the changes that are happening. I think we have time for a little bit more. One question that we have is sort of, again, applicable to, and this question actually came off of Slido, so if anyone has any questions, please go to Slido, put it in, upvote it, and we'll try to throw it in. But what is one thing that you can do at each age? Maybe we segregate it by age, each decade, 20s, 30s, 40s, 50s, that you can sort of do in order to prepare yourself for retirement, in order to ensure that you have a secure retirement. So would anyone volunteer to take so we have 20s, 30s, 40s, 50s. Joe, you volunteered for the 50s, if I'm not wrong. So let's start at the 20s. Does anyone want to volunteer and take the 20s first?
How do you guess my age?
Yes.
I'm 25, so I should do
There you
this.
go, please. So what should someone in their 20s do? So we actually have that question, which is someone, just starting to work in the 20s. What should they do now to really think about retirement, to prepare themselves?
When you talk about the financial planning, it all starts with savings. Without savings, there's nothing to talk about. Growing your money. Right? One of my favorite phrases is, if you don't save for the future, you have no future. So especially at the critical life events or transitions in your life, you got to think carefully about this. So one critical life event for most people is when they transit from a student to working. And typically when you're a student, you don't have much money, you survive on a modest allowance. When you get your first paycheck, it's a significant jump. So at that point, what you do with your money it matters a lot because it happens every month. If you are able to continue living like a student, even though you are no longer a student, wow, I think you're off to a fantastic start. And then later on, another significant event for a lot of people will be when they get married. And then this is where necessarily you have to reconsider your finances and work out a new financial arrangement. And again, how you manage your finances will be very important. Allow me to just share a personal anecdote. I received good advice when my wife and I were getting married. And the advice was, we were both working, quite typical. And the advice given to us was live on the income of one. Although we were double income, live on the income of one. And that means effectively it's something like a 50% savings rate. Wow, that gives us a good foundation in our finances. And if I may sidetrack a bit, deviate a bit, on hindsight, we found that actually it has a tremendous benefits beyond money. Then a few years later, the baby come out, and then at that time, another important decision about child rearing, who to look after the children. And that's when my wife and I looked at options, we decided that my wife would become a homemaker and stay at home. And that is possible because we were living on the income of one. Had we been spending more, I don't think it's even an option that we would look at, consider seriously. So this is something which actually costs money, but to us it's priceless. We have no regrets about that.
That's a great piece of advice. I mean, sort of living below your means and saving that in anticipation of having that buffer, for certain life-changing events. Very, very interesting. And I guess, starting well that early, then, you go to the 4M65, 1M65 thing, the compounding effect that everyone's talked about. Thank you. 30s, will anyone volunteer to take take the 30s for the 30-year-olds in the audience? How should
I mean, look, I don't mind doing the 50 because I think 50 is the new 20, but I do the 30 as you offered. I think for me, it's important not to procrastinate. Don't wait too long. Yes, indeed, you need to have a job and you need to have savings for you before you can talk about investing. I think no amount is too small. But obviously, whether you're 20 or 30, and frankly even 50, but if you start earlier at whatever age group, you probably can afford, because given the lifespan, you probably can afford to make some mistakes. You probably have a longer runway to have some luck. We need luck in the end too, besides having those knowledge. And the time value of money, if you start earlier, obviously is in your benefit. But I would re-emphasize that no amount is too small. Today, listed stocks are down to 100 shares per lot. So depending on the value of the share, one could afford that. Or if you want it to be professionally managed or be disciplined around that, you could also have a regular savings plan, with which many banks and security houses work with the exchange to try and promote that.
Right. And I think to your point exactly, I think it's really important that we start early. And one of the things, actually, one of the greatest issues that a lot of people that we talk to face is just that inertia, that unwillingness to start and take that risk, that first step. And we always tell them it doesn't matter how big a step you take, just start. And then that gets the momentum going. So 40s, I guess that leaves Lou on the 40s.
Well, I would like to take two spectrum.
Please.
And this is a live example, and it's very fortunate we've got Cherian here as well. I think it helps when you're young. So in my case, maybe in the late 20s and early 30s, I had the privilege and honor to be mentored financially by Heng. So we have known each other for 20 over years. And I came from a position of not knowing much, and I think that training, that counseling and training, right, not just financially, sometimes also to handle life in terms of money aspect and things like that. I think that helps a lot. So I think when you are young, I think even Jack Ma says that get yourself a mentor, okay, a business mentor, a life mentor, a financial mentor. I think that helps. So and Chye has been incredible in that process. So now, for those people in their 40s or 50s, especially for people who have reached there or already well-to-do with lots of wealth of knowledge and experience, maybe turn it the other way around to also start mentoring others. And with that light, that's why we started 1165. To repay the good that Chye has given it to me. There's nothing I can give back to him, but so we pass it down. That's why we've done this movement. But I thought that spectrum is quite important. That we eagerly seek out to receive knowledge, and then when we reach there, we give it back.
Right. Good karma goes round and round.
That's called pay forward.
Pay it forward. 50s.
Well, let me just add a corollary to what Chye said. I think living within your means is a very good advice, and I'm a believer in that as well. Sometimes, even in America, I saw, since I spent most of my life in America, people bought homes they couldn't afford, and then they took second home, what they call HELOCs, second home equity loans, to do even more of that stuff. And then when the market crashed, it became a problem. So living within your means is important. But I also remember a Nobel laureate telling us once, and I think you know him because I see his company also as one of your partners, said, there's nothing worse than not saving enough for retirement. The next worst thing is saving too much. Instead, that means you didn't enjoy life. You got to also enjoy life. You got to do balance things out, not overspend, but rather enjoy life. So coming back to the people who may not have had enough at their 50s, because they're now about 10 years away from retiring, right? I would take stock of what you have in your savings and reevaluate and say, am I able to maintain what I call my standard of living? Because economists have shown this. Investment studies have shown this. Investment funds have actually teased this out of clients. Nobody wants to drop their standard of living once they retire. They'd like to maintain at least some percentage of it, maybe 80%, maybe 90%. So if you find that you can't maintain by using a CPF planner or whatever situations, find out, hey, wait a minute, I may not have enough for retirement once I retire. You may want to consider, how do I make up for it? There are 2 or 3 ways. One is to work longer, if you can afford to, if your health is good. The other is just save up more now. It's not much of a runway, but still save up more. Or the third, and I keep coming back to that because the large fraction of Asia's retirement funding problem will be solved if people, because a lot of Asians own their homes, if they're willing to monetize their homes. In America, people willingly go into reverse mortgages, even though they are so expensive. In Asia, thanks to Hong Kong and Singapore authorities, reverse mortgages, you call it the lease buyback scheme, are much cheaper because it's governed by the government. It's a fantastic opportunity to make up for any shortfall for retirement. So if you're in your 50s, think about that. That's my parting advice.
Great. Thank you. I was going to jump into Q&A, but I think we've run out of time. This has been really fun, actually. Thank you so much, all of you, for joining us today. And just a reminder to the audience, if you missed any part of it, please feel free to come back again after the sessions, and there'll be replays available online. And thank you so much for joining us again. Thank you.
Thank you.